Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include prepayment characteristics of mortgage borrowers, my interview with Argyle's John Hardesty on what's driving lender migration in the LOS and POS space, how tech stacks are being evaluated more strategically, why conversion matters more than ever in verification workflows, and what true interoperability means for mortgage fintech, and just at what point are we going to see a flight to quality? Thanks to today's podcast sponsor, Optimal Blue. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership. For many, business is slow out there. Depository banks continue to focus on residential lending in their own footprint while scaling back distant originations, and IMBs continue to look at staffing with a critical eye. A safe prediction is that this will continue. Over time, I've grown more skeptical of people making predictions to grab headlines. A recession has yet to materialize, nor has a tidal wave of delinquencies and foreclosures. In fact, quite the opposite. The OCC Mortgage Metrics report from the first quarter of this year showed that 97.6% of mortgages included in the report were current and performing at the end of the quarter, an increase from 97.4% 1 year earlier. And the percentage of seriously delinquent mortgages decreased from the first quarter of 2024. Maybe that's partially because there's now more integrated sales strategies that align with operations and capital markets, and leadership is intent on driving holistic business performance. Let's switch gears slightly here and talk about the economy. Economic data of late has shown further signs of cooling. May retail sales dropped 0.9%, industrial production declined for the third time in 5 months, and housing starts fell nearly 10% to their slowest pace since 2020. Overall, the tone is one of growing caution amid a landscape shaped by consumer pullback, softening activity, and tariff-driven uncertainty. The key economic story this past week was the Federal Reserve's June policy announcement. While there was no surprise in the Fed holding its target interest rate steady, the updated summary of economic projections and dot plot revealed deeper divisions within the community. The Fed remains in wait-and-see mode, particularly focused on how recent tariffs will affect inflation and employment. Back in March, the median projection suggested a 3.9% rate by year-end, implying 50 basis points of cuts. That projection held steady, but the underlying consensus has weakened. Only 12 of 19 members now expect at least one cut in 2025, down from 15 previously, and expectations for rates in 2026 and 2027 have ticked slightly higher. The shift reflects slightly worse forecasts for inflation and unemployment, but no clear momentum toward easing. Powell acknowledged the recent improvement in survey-based uncertainty, driven by partial tariff rollbacks, but those surveys predate the latest escalation in Middle East tensions, possibly rendering the Fed's optimism stale. At this point, markets are split between expecting one cut or none, and in all likelihood, that's where we'll land unless economic data convincingly breaks one way or another. For today's interview, I wanted to welcome back to the show Argyle's John Hardesty to talk about what's driving lender migration in the LOS and POS space, how tech stacks are being evaluated more strategically, why conversion matters more than ever in verification workflows, and what true interoperability means for mortgage fintech. He's general manager, mortgage division at Argyle, and he's kind of my go-to for offering insights on optimizing income and employment verifications for mortgage lenders.
The POS and the LOS space, there's been a ton of lender movement lately, and you've obviously had a front row seat to that. How are lenders evaluating their tech stacks differently now than they were a year ago or 2 years ago?
Great question, Robbie. And first off, again, thanks for having me on. I think this is number 5 for me and you to chat. So I always enjoy this time together. I think it's all in this market. It continues to be about speed and how much more can you do up front to qualify borrowers faster. Super competitive. You've talked on that before. This market, super competitive. And I think lenders are looking at, whether it's advancements with AI or putting certain low-cost services up front to qualify, verify in our world faster. Those are the themes I'm hearing. And, just being on the road like yourself at conferences, like, I saw you at Insight, right? Like a lot of their product enhancements are around how can I, get applications in, grab documents faster, and qualify faster. So I just think that that theme of speed is still remains. And how can I get my brand out there, and have that brand presence in a variety of different locations where you could pick up a new home buyer. So lots of good things happening in the space. And yeah, we've certainly seen that ride happen with Argyle.
We're also seeing companies trying to lower cost. And there's a lot of different philosophies on how that might be achieved. Obviously, humans are the largest cost in the origination process, but it's hard to cut compensation of humans. There's emotional ramifications, there's legal ramifications, all those things. When it comes to cutting costs without cutting corners, where do you see the best opportunities right now?
In terms of cutting costs, and again, I will speak solely to just like the verification and landscape here and this answering this. Um, the industry overall was used to a 60, 70, $80 charge to get credit bureau data, right? What we've done and what others in the space are doing is saying, how can I get that data cheaper but faster, right, to cut costs? And I think you've seen advancements of this in the point of sale space, like an Encino, like an Inflowify, right, where you're leveraging these services in an automated fashion, whether it's in-app, Robbie, or post-app via the task list. And I'll double click on what that means. Like a lot of movement in the space has been around how can I take an app in, assess credit, assess, are they credit qualified, and then push out my verification so that I'm not dumping costs into someone that may not close. And I think you're seeing a lot more automation. And then with that, services like Argyle that can cut costs, and we've seen it at scale with some of the largest lenders in the country. I mean, it can really drop really fast with automation. So it's not really cutting corners. It's just being smarter with the new tech that's out there. And I think that's what's happening in the space right now.
There's also a conversation when we're in the verification space, and I know Argyle uses the term conversion rather than pull through. And when it comes to lenders trying to grow volume, I'm wondering why you view the word conversion as kind of the operable term there, and why that's so important. Why does that matter for lenders trying to grow volume?
I think it's important when you think about conversion in our world. It's you're putting out, these consumer facing experiences, and how often are those consumer facing experiences like Argyle giving you usable data on the back end, right? And that's why we lean a ton on our focus on conversion. If you're going to see the ROI, like we just talked about, the cost savings, you need the consumer facing experience to convert, Robbie. And we lean heavily into that. And we want this to work every single time that you put it out there. It doesn't for a variety of different reasons. But the more we can get that from 40 to 50 to 60%, the more cost savings we're giving on to our lenders. And then being able to actually use these reports to obviously fund the loan. So conversion, big in our world, and something that we don't lose focus on for sure.
There's another term out there that I understand a little less than conversion, and maybe that's because it has a lot more syllables, and that's interoperability. It's become a hot button issue in fintech. Can you explain what that means for probably for my sake, but also for listeners? What that looks like in mortgage and why lenders should care about it.
Robbie, I'm laughing because that's the same debate that we had internally when we were bringing this idea to market with some of the integrations that we put in place. I think for a long time the tech stack was segmented. Whatever happens in the POS stays there. Whatever happens in the LOS stays there. So when we went down this path this year, we've added I think 6 point of sale providers into our ecosystem. We thought about, well, yes, the LO uses a point of sale, but you're going to want that data downstream for when you're at the closing table and you need to reorder or reissue a verification. So we kind of get this idea of interoperability, meaning what happens in one place is usable in another piece of the tech stack. And it's become a huge, huge value add to our customers because in that example, your closer needs that same connection that happened in the point of sale, but they got to get to it in Encompass, right? So building the DNA and the framework to make everything work together is something that we think of, and we talk about it as every aspect of loan manufacturing can use what happens in one system in the other, and that's really, really important for speed in terms of processing time.
It's certainly cool to see the way technology is evolving the process and bringing everything together, but it seems like there's still kind of a gap between fintech innovation and adoption out there. I'm wondering what you think is holding lenders back from adopting better tech, or what could change that would assist that.
Yeah, it's simply just change management and getting used to the new ways of doing old habits, right? And I talk a lot, publicly on change management's the key when you're buying a new software, right? You've got to be committed to get in front of your production team and your processing team and even your closing team and say, here's the value and here's how this is going to be used in your persona, right? And really buy into it. Because if you don't, and you've heard this, Robbie, I'm sure, like there's a lot of tech spin that doesn't get used. And I think your providers, and I know I focus a ton on this with our clients, is we're looking at LO level data to make sure usage is high. We're taking this every week to our clients and looking at, who's doing really good, who's maybe struggling a bit. Let's get them in a room together with us in there and whiteboard, how this one person is seeing such high conversion, right? So a lot of it is just you got to go in, and that's in mortgage sometimes really hard to get behind new software, but it's important when you're vetting it, you're asking those questions about how are you going to help me onboard, implement, and adopt this tool. And I think that's critical, especially in the era of AI and new tech everywhere, asking those questions up front.
Well, I think something kind of hovering over all this is trust. Do you trust your vendor partners? Or I host a monthly show, Mortgages with Millennials, with Kristen Messerly, and trust in financial institutions in general has gone way down. It seems like there's a lack of trust in this new technological age, which speaks to the mortgage industry's focus on relationships. It's obviously good to have those, and they're not necessarily going by the wayside overnight as technology gets better. But when it comes to how this uh, trust of financial institutions is impacting the way borrowers view them, is that influencing product design or go-to-market strategy at Argyle? And if so, kind of how are you building trust into what you're doing?
We we take a very detailed approach to our product enhancements, for example, and bringing the lender voice, our lender advisory board, helping us build the future. We're already talking 2026, which is crazy, right? Where are we going to go? What products are we going to build? What enhancements are we going to make that lenders need? And I think that inherently, that kind of model, that lender first model from a vendor side, is critical to building trust. If I know you know me well, Robbie, but a lot of the people that we've brought into Argyle have deep history in the mortgage space. Why? Because it builds trust when someone from the vendor side can say, hey, 5 years ago when I was, on the production side or I was on the operation side, little things like that to say, I sat in your shoes and here's how I could use this tool or that tool better, is really critical. But I think it first just starts with making your customer voice very heard in your roadmap and then delivering on that. Because if you do that, then I think, any mortgage lender would say, hey, they're doing their best to do their job and they're keeping us in mind when they make those decisions.
It's an excellent answer. I always enjoy talking to you. It's funny you brought up the 5-time club here. I'm not sure how many people do that, but maybe like Saturday Night Live, we need to start doing bathrobes or something for repeat. Always a pleasure talking to you. So thanks for making the time.
Robbie, as always, good to see you, man. And I'm sure we'll do this again soon.
Now that the U.S. is involved in the conflict with Iran, will we see a flight to quality? This week's key events include the $183 billion in month-end coupon supply, which will be auctioned over Tuesday to Thursday, with key data including S&P Global PMIs, several housing-related data, points, durable goods orders, the final look at Q1 GDP, with PCE and Michigan sentiment on Friday. Fed Chair Powell will also testify on the semi-annual monetary policy report to Congress, and we have Fed speakers throughout the week. Regarding MBS, Class D 48 hours is tomorrow, and today's calendar gets underway later this morning with preliminary S&P Global Manufacturing and Services PMIs, and will be followed by existing home sales and remarks from San Francisco Fed President Daly, Governor Waller, Vice Chair for Supervision Bowman, Chicago's Goolsbee, and Governor Kugler. We begin the week with agency MBS prices slightly better than Friday's close, and the 10-year yielding 4.35 after closing Friday at 4.38%. Let's wrap up with a joke and some housekeeping. A cat owner invited their neighbor over for dinner and introduced the 4 cats. That's A-Log, A-Ract, Erpiller, and Astrovy, they announced. The neighbor was surprised and asked, "Where on earth did you get those names?" "Oh, those are their last names," the owner said. "Their first names are Cat." So catalog, cataract, caterpillar, catastrophe. Thanks again to Optimal Blue for sponsoring today's podcast. Optimal Blue bridges the primary and secondary mortgage markets to deliver the industry's only end-to-end capital markets platform, helping lenders maximize profitability and operate efficiently so they can help American borrowers achieve the dream of homeownership.